Well, it finally happened. Warren Buffett is back, sharing his view on the current stock market. He thinks we might soon see a lost decade where the market gives no real returns over the next 10 years. Some people say Buffett is stuck in the past. But betting against him has often been very costly. And even though history doesn't repeat itself, it does often rhyme. So let's start by looking at what Buffett's company, Berkshire Hathaway, is doing with their money. This is similar to what they did before the last lost decade, when the S&P 500 had no real gains for 12 years. We'll also see how this strategy has helped Buffett be one of the only top billionaires to make money in 2025. And at the end, we'll talk about how to follow this plan without just copying a billionaire. Your subscription, like, and bell are the best support for the channel. Despite all the noise in the market, Buffett has been quiet. His last big move was selling over $130 billion in stocks. Since then, we've learned a lot about what Buffett thinks just by watching what he's done. After his big 2024 sales, Buffett is holding over $341 billion in cash. That's more than a third of his company's total value. He's not using this cash to buy new stocks because he doesn't see good deals. Even his own company's shares aren't worth buying, so he's holding the cash in short-term U.S. treasuries that pay 4–5% a year, bringing in about $13 billion for Berkshire. This sends a strong message to investors. For those who look for patterns in the past, this situation feels very familiar. The 1990s ended with a big boom for stocks because of excitement around new dot-com companies, which drove crazy prices in the market. That year, Buffett wrote his usual letter to shareholders. These letters are still public and show what was going on each year. In 1999, Buffett warned in that letter that stock prices had become separated from what companies were actually worth. He said investors were too optimistic about future returns and expected too much. He also warned that there would be a lost decade ahead, with no real gains in the market for the first 10 years of the 2000s. Back then, investors didn't like hearing this. They said he was a dinosaur and didn't understand modern tech like the internet. People today are saying the same things again, but we know what really happened. The history. In 2000, Buffett was proven right. The market only gave 2% per year from 2000 to 2012, which was less than inflation. This was called the lost decade of investing. So during that time, things like bonds and dividend-paying stocks did much better than the overall stock market. It's interesting because today, Buffett is also heavily invested in bonds and treasury bills, just like in 1999. Back then, he didn't buy stocks or even his own company's shares, same as he's doing now. Let me show you some other numbers that back up the idea that the market might repeat what happened in the early 2000s. Then we'll talk about Buffett's strategy and what regular investors like us can do. The first thing to look at is the Buffett indicator. It roughly shows how expensive the stock market is overall. You calculate it by taking the total market cap of all the companies in a country like the US and dividing that by the country's gross domestic product, or GDP. It basically shows if the market's rise matches how much the economy is growing. In a 2001 interview, Buffett called this the best measure of how expensive the market is at any time. In 2000, during the dot-com bubble, the Buffett indicator went up to 140%. That was a sign the market was way too expensive before the crash. The same thing happened in 2007 before the big recession, and again in 2021 before the market corrected. Every time this metric goes over 100%, there's been a market correction afterward. Right now, it's at 177%, matching what Buffett has been doing, showing that the stock market is way ahead of the real economy. There's also a second measure called the CAPE ratio, or Shiller PE ratio. It's named after Robert Shiller, who won a Nobel Prize for studying market bubbles. This measure is made to show market bubbles. You get it by dividing the current price of the S&P 500 by the average earnings of those companies over the past 10 years. The Shiller PE ratio has a long track record. It rose before the 1929 market crash. It also went way up in 1999 and was high before the 2008 crash too. So whenever the Shiller PE ratio goes above 15–16, it suggests the market could be in bubble territory. Today, this ratio is about 33, which is more than twice the usual average. When both these measures are high, the market usually corrects afterward. But haven't we already seen a correction? The markets have pulled back a bit recently. CNN says we're not in a hype cycle right now, but rather in a fearful mood. Still, the numbers show that prices are staying high anyway. So why is this happening? And what does it mean for the market's future? The reason has more to do with human psychology. Buffett has a great way to explain what's going on now, using a story he told back in 1999. He called it Cinderella at the ball. He said the line between investing and gambling isn't clear. It gets even harder to see when people have recently made a lot of money in things like tech or AI. After making lots of money, usually careful people start acting like Cinderella at the ball. They know that staying too long at this party, buying into overvalued companies, will turn into a disaster. But they can't stand to miss the fun. He said, the giddy participants all plan to leave just seconds before midnight. There's a problem, though. They are dancing in a room in which the clocks have no hands. That's exactly where we are today. Investors know there's risk, especially after the recent dip. But no one wants to leave the party too soon. But Buffett isn't even at the party. He's doing something completely different right now, just like he did in 2008 and before the dot-com crash. So, what exactly is Buffett doing that's helping him make money in a falling market? And how can we use the same ideas, even without billions of dollars? The strategy. One key is consistency. It's about putting yourself in a good place to grab opportunities when they show up. This means investing regularly and adding more as your income grows. But most people don't do the second part, growing their income in a strategic way. Now let's see how Warren Buffett has been making money even when he doesn't see good deals in the market, and what we can learn from this. Let's start with a common idea that Buffett never times the market. It makes sense why people believe this because he's said many times that he doesn't. Here's a great quote. Buffett once said, "Market timing is both impossible and stupid." Even if he doesn't time the market like most people think, he does adjust his strategy when the data changes. That's something we can learn from. Let's look at how he handled the last big crash in 2008. Buffett happened to have billions in cash right before one of the best buying opportunities ever. He put $20 billion into struggling companies, including Goldman Sachs, and made big profits when most investors were losing money. He even wrote an op-ed called, "I'm betting on the U.S. economy long term." Buffett may seem like an old gentleman, but he's a very strategic investor. After all, you don't get that rich just by luck. Buffett's big strength is his independence and his readiness to spend big when the market is down. He doesn't have a boss demanding quick results, so he can wait patiently. So, back to that $341 billion bet Buffett is making today. He's holding it as cash. Remember, that's 1/3 of Berkshire's whole value. And he's happy earning 4 or 5% from short-term treasuries because he can wait. This isn't panic or fear. It's discipline. He's waiting for the market to drop so he can buy great companies at a discount. Buffett explaining how he made money in the 2008 crash without really timing the market. He said, "We have not been good at timing. We've just been good at seeing when we're getting enough value for our money." Just like in 2008, 1999, or even back in 1987, Buffett's plan for crashes is to prepare for the worst, not chase short-term gains, not short the market, and just wait for good deals to come along, like they always do. Warren Buffett's old partner, Charlie Munger, said it best. "The big money isn't made when you buy or sell a stock. It's made in the time you hold and wait." Munger also said about today's market just 9 months before he died, "I think investing is going to get harder for everyone. The smart people bet big when they have good odds, and the rest of the time they don't. It's that simple." The plan. So what does this mean for us as regular investors? First, be realistic. Don't panic or get too excited. You don't need to copy Buffett, but you should see what his caution means. Good deals don't happen every week, so be patient. He's getting ready for something big, maybe a big drop in prices of solid, cash-generating stocks. If you can, now's the time to add as much cash as possible to your investment accounts and get ready for deals. That might mean spending less or earning more. Whatever you can do now will grow fast when deals show up, because history says they always do. Was it helpful? Let me know by liking and subscribing.